Now, let's move on together to discuss both the income statement and the cash flow statement. We're going to start with the income statement. Now, the income statement has many names. It could be called the statement of operations, or the profit and loss statement, or the P&L for short. But whatever we call it, it's still representing the same thing. It contains the transactions of a company over a period of time. Now, as you already know, the income statement starts with a zero balance at the very beginning of a fiscal year and then contains all of the transactions affecting revenues and expenses throughout that period, typically a year. Now, at the end of any period, it summarizes the amount of revenue earned, expenses incurred, and the net profit or net earnings after depreciation, interest, and taxes are all factored in. Remember that profit, earnings, and income also all mean the same thing. They're synonyms. Therefore, the importance of the income statement is really showing the profitability of the companies. So let's now look at some of the line items on the income statement that need a little more explanation. Directly below the revenue line, which is at the top of the income statement, comes the direct costs of whatever the company is selling. And these direct costs are often referred to as cost of sales or cost of goods sold. We typically will use cost of goods sold, or COGS for short, that's COGS, if the company is selling some type of tangible inventory. If it's selling a service, we will call it cost of sales instead of cost of goods sold, because that's normally what we see in service-based industries. For our purposes, and as we talk throughout the rest of this course, we're just going to refer to everything here as cost of sales. Now, cost of sales may be shown as a summarized line item, just one line on the income statement, or it may be broken down into individual components to arrive at a subtotal. These individual components are the expense items directly related to the production of the good or service. I want to stress that again. Cost of sales have to be costs that directly relate to what the company sells. So, for example, in order to manufacture a good for sale, there will be the cost of raw materials, as well as the production cost to turn them into a finished good. These costs are allocated to inventory on the balance sheet, but then when the inventory is sold, it's transferred to the income statement as an expense item under cost of sales. Now, in order to deliver a service, typically we have direct labor costs involved in the delivery of that service, and those costs are directly allocated also to cost of sales. Finally, there may be also some other allocations such as overhead, as long as they're directly related to the production of the good or service that would ultimately be included in the cost of sales figure reported on the income statement. Another important line item commonly found on the income statement is a line entitled Selling, General, and Admin Expenses, or SG&A for short. Now, SG&A typically contains a large number of diverse expenses that are all grouped into one line item on the face of the income statement. Now, examples of things that might fall into SG&A include things like advertising and promotions. It could be professional fees, such as legal fees, insurance, and accounting. It could be office supplies, rent, and other related expenses. As you can see, all of these expenses are related to selling, admin, or other activities that aren't directly attributable to the good or service being sold. Another income statement line item to draw your attention to is related to gains and losses. Now, these may be shown separately or may be grouped under other income and expenses. And typically, this appears after all other operating expenses are presented. Now, gains and losses are related to activities that are incidental to the operations of the business. Another way of framing this is it's non-core. It's the opposite of the operations of the business. So these tend to be one-off things or items that really aren't operational in nature. So for example, it could be gains or losses that occur when an investment or a piece of equipment is sold. The same holds true when financial instruments are recorded at one amount at purchase, and then they need to be adjusted up or down to give them their fair market value. So depending on accounting policies followed, the adjustments may be made as a gain or loss that will appear on the income statement. Some companies will recognize income from equity investees, sometimes known as income from associates, also in this line. Now, recall we cover accounting for equity investments and business combinations in a separate course. So if you want to understand more about how income from equity investments is recorded on the income statement, check out that course. Okay, let's actually now explore Starbucks' income statement, and we'll also dig into the notes when we want to get some more detail. Remember, using the financial statements alone is only part of the story. We need to dig into the notes to really understand the story. So I'll do a bit of that as well. So I've gone back to page 3 of the PDF, and I'm going to go Control-Shift-N, and I know it's page 45 of the PDF. It's printed page 42. I'm just trying to speed it up. So again, you should see 42 on the bottom of your PDF. I'm going to just scroll up so you can see as much of this on the screen as possible. We just don't see what's cut off is my weighted average shares outstanding. So what we see is we have revenues. Again, most of the revenues by far coming from those company-operated stores. That's of interest. Then we see our operating costs listed and other operating costs. We have depreciation. There's our SG&A. In this case, it's just called general and admin rather than selling general and admin. But then we have something called a restructuring and impairment. And we'd want to know what does that relate to. So what I'm going to do is I'm going to actually, that's roughly 22, and that's in millions. So that's roughly 22 million and 46 million the previous year. I'm going to just go Control F and hit restructure. And don't do the whole thing. Good. Let's see. Oh, and we have it on the first page. Let me scroll up so you can see it. And I can see already those are the numbers that I was just setting on the income statement. But in fiscal 2022, we announced our plan in the U.S. market to increase efficiency while elevating the partner and customer experience called the Reinvention Plan. And it's part of that. It's really that. That is the restructuring costs. Okay, so one of the reasons I do this is I want to see if it's a one-off, is it operational? I would have included this as an operational cost because it has to do with their experience in their stores. So I'm going to go back now, Control-Shift-N 45. And we get our total operating expenses. Then we have, remember we talked about other gains and losses. So here we have them not one line item. We actually have them split out. So there was a gain from the sale of assets. So remember, these are incidental to the business. They're not core operations. And then that's income from equity investees. So apologies, that's 298. And equity investees are those companies where Starbucks has a significant influence. It doesn't control them, but owns between 20 to 50%. And then we have right below that, a small gain from sale of assets. Although I guess small is relative, it's still 91 million gain. That leads us to operating income. Now, operating income is often referred to as earnings before interest and tax, or EBIT for short. So just remember those synonyms. Okay, then what we do is we're going to see it was back in 2021, there was another unusual item. Then we typically will see our interest income and expense, and that will give us our earnings before income and tax. And now I'll just scroll up again. So we got our earnings before income taxes. Then we have their tax amount. And let's say we want to figure out what's the tax rate that the U.S. part of Starbucks is subject to under U.S. federal income tax. So what I'm going to do is I'm just going to go Control F. I'm going to go federal income tax. Good, it took me right there, and you can see the statutory rate federally is 21%, but then there are other taxes due to the things that, like state income taxes and so on. So the effective tax rate that Starbucks is subject to is 23.6, slightly more than the statutory federal income tax rate. So if we wanted to find that information, again, you see it's in the notes. Let's say we wanted to find something like, we want to know revenues for China. Let me just scroll down. There we go. Here we have segmental information. It's typically near the end of the note section. And here we see the total revenues and what of those revenues are coming from China. And you can see the number here. Now, remember, those are in millions. So that's 3 billion. So just something to think about in terms of revenues. Okay, so now you have a go seeing if you can hunt down the answers to some of our questions, and then we'll see you in the next lesson. Bye for now. The cash flow statement or statement of cash flows is the last financial statement we will review together. Using information from both the income statement and the balance sheet, it organizes all of the transactions that affect cash to arrive at a net cash movement for the company for the period or the year. Now, when the opening cash balance from the beginning of the year is added to the net cash movement, the closing cash balance will match the cash reflected on the balance sheet. The importance of the statement of cash flows is an understanding of where cash is being generated, but also where it's being used in the business. Now, cash transactions on the cash flow statement are sorted by activity type. Specifically, they're sorted by operating activities, investing activities, and financing activities. So let's start with operating activities. Operating activities relate to the day-to-day business operations, essentially the revenues and expenses that have been collected and paid during the year. Next is investing activities, and these relate to investments that support the business. So cash is used, for example, to purchase property, plant, and equipment, and cash is received when any of these assets are sold. Business acquisitions are also considered investing activities. A company needs to be investing in its business if it wants to remain both viable and competitive. Finally, we have financing activities that relate to transactions involving equity or debt. Essentially, if the company doesn't have enough cash generated through its operating activities to finance its investing activities, then it may be required to raise funds. Now, a company can raise funds either by borrowing or by selling shares. To the extent that a company has excess cash, it may choose to pay down debt more quickly or repurchase its shares.